Kia ora, everybody. Welcome to our latest webinar and our final webinar for 2022. It's great that you can all join us. I'm David Faulkner. I'm the General Manager of Property Management for Property Brokers. And with me is our seasoned academic, Professor Graham Squires, was of Massey University, also Director of Property Knowledge. And there's some changes in your life here, Graham. What's going on? You're not going to be in Palmy for much longer, by all accounts.
So, yeah. Moving on, trading Professor of Property Studies at Massey University to Professor of Property Studies at Lincoln University. So Lincoln's just outside Christchurch, so I'm uprooting from Palmy, moving to Christchurch. Looking forward to the change, looking forward to working in a new city, new students. We've got I'll be part of a 4-year land and property management degree, so I'm sure you'll be quite interested in what we do there. So it's connected in with management, development, investment, finance, economics, valuation. We look at urban and rural property. So there's a lot going on there. Yeah, so same stuff, different town, I guess.
Yeah, but I mean, off topic a little bit from our webinar today, but of course, I mean, we saw the announcements, was it on Monday or Tuesday, about them going to regulate the property management industry. So that's good timing for you, really. I mean, you're going to may even have a bit to do involved in that.
Yeah, university sort of works a lot of sort of what's referred to as level 7 stuff.
A
lot of the regulation stuff will work around level 5, I guess.
Or level 4.
Level 4. Yeah. So yeah, it tends to be anyone who goes through that degree covers a lot of understanding of what the real estate authority do, what RINES do, all those sorts of things. So I guess the degree won't be at the sharp end of that regulatory conversation. But certainly the broader principles, that you'd expect in a broader bachelor degree that will be covered, and it's all accreditation sort of covering in terms of the RICS, Royal Institute of Chartered Surveyors, the Property Institute, REA, RINES, all the usual suspects. So yeah, certainly all about professionalising the industry, which I enjoy doing, and research as part of that remit, I guess.
Well, so what we're going to talk about today, and looking at rents. Now, as we're all very much aware, we're seeing a slowdown in the housing market. You're seeing that prices are starting to retract, particularly in places such as Wellington, but also amongst other parts of the regions as well now, and some of the provinces as well. I'm wondering if the same is going to happen with rents. We've seen interest rates, they've been traditionally very, very low for quite a long time. They're now getting back up to levels of what they were pre-GFC, which wasn't unusual back then. To say, go to the bank, you've got to be looking at 6.5%, 7%. And people coming off 2.5%, that's going to hurt them, Graham, isn't it?
Yeah. I think we've seen New Zealand, big picture, the growth in the investment sector. Property management as a sector has increased. So there's a lot more people invested in the market, a lot more geared. Interest rates are a lot more sensitive to a lot more people. The thresholds that people can work with in terms of receiving rents is going to be a lot more squeezed. So I think we're dealing in a whole new different context now. But I think it's really interesting to look back at, when we've seen periods of when rents have gone down, to see, well, what different macro levers, were then and now and into the future. So
let's take us on to the question. And for all you people watching this, you can download. We do a quarterly report, and we'll be able to send you the link and share this link with you at the end of this webinar, where Graham will do a quarterly report with myself looking at what's happening. We'll pick a different topic, and the topic we've done for our third report is, do rents actually ever go down? Graham, do rents ever go down? Have they ever gone down in New Zealand? We've seen records really since 1993 from Tenancy Services and MBIE. I don't think it would have been called MBIE then. But have we seen a trend where rents have actually gone backwards?
Well, the answer is yes, but only just. So we look back at looking at the trends and the broad trends. We saw, but between 97 and 2000, an actual a significant in the big picture in terms of Auckland as a region falling from, the numbers then 266 a week, falling down to 246 between that 97 to 2000 period. So
that's a $19 drop. Yeah.
So it's sort of, in the big picture, it's probably a stalling of the market. But you can actually, when you look at the graph and when you look at the report, you can see that sort of downward-ish trend before it picks up again.
We saw something similar in Christchurch after the rebuild. I mean, and we
Yeah.
would have talked about this in previous webinars. I mean, obviously, inflation would if inflation have impacted rents back then? What was happening with inflation? Because everyone's talking about inflation now.
Yeah.
What happened with inflation back in that period between 97 and 2000?
Yeah.
Did it do anything?
I mean, the figures we're looking at, well, now we're looking at what, 7.2%, something like that for inflation. So back then, you can't really play the inflation card. It was at 1.1% in 97 and 0.5% in 2000. So negligible inflation, usual government regulations are around, well, usual sort of optimal sweet spot is anything between 0-2% is the sort of sweet spot for sort of inflation to keep it under control. So 7%, that's why the alarm bells are in there at the moment that we're all aware of, and questions about using interest rates as a way to dampen the market to rein in inflation. So yeah, figures at around 1%, 0.5% weren't of a concern then.
So why did we see rents? Is there anything similar to what's happening today? Because we've seen rents go up rather quickly, and at some point they can't keep going up at. I mean, traditionally it's about 4% per annum. If you look back at records in recent years, it's been closer to 7-8%. And in places outside of Auckland, we've seen some places going up by 15%.
Yeah.
I mean, was there anything happening back then which led to rent stalling?
Well, the big macro picture, and we've got an appendix in the report from the then Governor Don Brash, and the big conversation then was about exchange rates, which is rarely talked about. We see all these reports from various economists coming through, and that was the big story of the moment, in terms of what the New Zealand currency was doing relative to the dollar. That's sort of part-ish of the conversation. We hear, the stories from the UK in terms of, how the British pound was tanking because of various political blunders. But I think then that was the big ticket item, was all about trying to keep the exchange rate under control and keep.
So how does the exchange rate influence what's going on, or is that? I mean, out of your brief, or
no? Essentially, it's about what things are worth. So if the New Zealand dollar is more expensive, things like property and things are more expensive, so they become more uncompetitive. So there's two ways you can look at the strength of the dollar in terms of whether it's a good thing or a bad thing, and it depends on all these other factors like growth and interest rates and things that drive the economy. But essentially it's if you've got an overinflated New Zealand dollar, things are more expensive, which could be a good thing. The value of property is higher, or etc. But you can't do that forever, because then it becomes uncompetitive, because other nations, in a relative sense, will be able to sort of get ahead in the market and provide cheaper goods and services. So it's a relative concept, I guess.
I got to remember when I came in 2001, it was about $3.30 to the pound, and I felt rather rich when I arrived here. I couldn't believe it. But anyway, that's changed now. Unemployment. I mean, we've got record low. In fact, I mean, we're crying out for labour, for people to come and work. What was happening back then?
Yeah, so the figures are around sort of 6%. So they went from
6%, and what is it now? It's about 2.3 or something.
3.3%.
3.3%.
Yeah. Right. So I mean, that's the thing. I mean, in terms of the economy, still, GDP still ticking along, employment's still ticking along. I think there's a lot of anticipations in terms of what GDP is going to do next year. There's a lot of recessionary type conversations that are coming through, but employment's still booming. Whether that's going to fall away, and that's the sort of the predictor, isn't it?
Yeah.
Recession comes, GDP slows down, recession, people getting laid off, all that sort of stuff coming through. So that will eventually be the thing that puts the brakes on inflation in the end. So not necessarily just interest rates.
So landlords who are getting these experiencing these hikes in interest rates, and the fact that they can't. Some landlords, we've seen the offsetting of interest deductibility. That's slowly starting to weed its way in. I mean, landlords are going to be trying to get more rent, I would suspect, to try and cover these extra costs. I mean, what, in your opinion, influences rent?
There's a feed-through effect of the wider housing market. That's sort of how that feeds through. I mean, there's obviously house prices have gone exponentially high post-COVID, and then we're hitting this sort of decline now. But it's sort of an interesting sort of market dynamic with respect to you got an investor market and you got a consumer market and you got the social market. But if you look at just the consumer market and the investment market, the investors have sort of backed away. When this sort of things happens, investors just say, right, I'm just going to hang on to my stock, or I'm not going to put it onto the market. So it's it's what's referred to as a lumpy good. People hang on to these things. So that still has to be maintained, and those mortgage payments still have to be paid, even if things aren't being released onto the market as a consumer. So I suppose there's a lot of concern over, as you indicate, the landlords are going to be considering how we're going to pay for these increases in interest rates, if they're going to remortgage, if they're going to hang on to the property and refinance, it's how they pay for that. So obviously that will feed through to what rents people pay. So there's going to be an upward sort of pressure on increasing rents. Whether the caveat to that is it just market correction because everything overheated and overcooked and everything's sort of correcting?
Do you think it's a correction?
I think it was still in a correction period. You look at the housing market went 40%.
So if you're sitting it long term, it's just we went up way too quick, too fast.
Yeah.
Part of me thinks that may have happened with rents as well, that they went up very quickly.
Yeah.
Particularly in the provinces, and they can't keep going at that 7-8%. What do you think
exactly
will happen there? Do you think that will level out a bit?
And exactly. And that's my sort. I think it does tend to follow that house price market to rent price market in a certain sense. But I think there's two different factors. It's the amount of stock that's on the market and whether people hold on to stock, point that I made, and it's also more people are more heavily invested in property than they were 20 years ago. When we were sort of looking at these figures. So people are going to be a lot more sensitive to how they're going to cover mortgages. A lot of academic work will look at they'll call it user cost. Whether balancing out how much you pay in the mortgage rates and how much you actually get in rents, and that is starting to converge. More people are getting more squeezed.
So let's just look at, you mentioned about the risk of recession. If people start losing jobs and there's a high pressure to increase rents from a landlord's perspective, is there a risk of tenants starting to default and get themselves into trouble? And I mean, how much of a risk is that?
Yeah, I think there's as well as sort of landlord risk, there's certain tenant risk as well, isn't there? And there's sort of it's a difficult product, if you want to call housing as a product, in terms of people. It's not like you can just sort of discard people who can't afford it. There's sort of social concerns here as well. So it's not just black and white in terms of they can't afford. People have a choice to move into a different property or a lower price property. People are locked in for 6 months. People are locked in for 12-month type contracts, aren't they? So,
well, we're seeing more and more switch to periodic, really, ever since we've seen the changes around the being able to give tenants notice, and you have to have a valid reason. It's almost kind of made the fixed term defunct, except in some of these markets where the students and landlords and investors want that certainty around that calendar, that student year.
Right.
But what could be a concern is again, it's a supply issue. If there's not enough stock, and if some landlords have to sell because of rising interest rates, and they're just realising, look, we can't afford to keep this rental property.
Yeah.
That could lead to another issue of shortage of supply.
Or people, and more people wanting to move into rental stock as well. Because of that sort of transience. Particularly people move around. The employment question that you mentioned. People are moving around of different jobs. Gig economy that's becoming more of a mainstream sort of concept, and people sort of doing short-term contract jobs. It might be a 3-month here. It might be working for one particular institution. It might be working in Auckland for another period of time, or freelance jobs. The rise of the internet, all that sort of stuff. So I think it becomes more market sensitive. Is where I'm going with that, in terms of people choosing what particular rental properties they're going to go into.
What does population have to do with rents as well? I mean, because we've seen a slowdown in immigration, almost to a trickle. We're hearing all types of issues out of Immigration New Zealand with processing of visas and whatever it may be. There doesn't seem to be an appetite of this current government to increase the numbers of immigration. Whether a change of government will change that. I mean, does that influence? What influence on rents does immigration have in population growth?
Yeah, I mean, population is always economics 101 in terms of being a key driver. income and population are usually the key drivers for price. So whether that's house price or whether that's rental price. So if we're seeing like an influx of population growth and numbers are sort of astronomically increasing, you would see that pressure on rents, you would see that pressure on house prices to a certain degree. However, property is peculiar, it's quite not a mainstream good. So I don't think, I suppose even if it is a key, well, it is a key driver and it is having a significant impact. What we see in New Zealand is we're not seeing astronomical influx, but we're not seeing astronomical decreases either. You look at the graphs, it's pretty uniform. In terms of what we're on, 5.1%. I mean, we're looking at, 5.1 million, and we're looking at about what in 2000s we're looking at figures of around 3.8 million. So I don't think I mean, it's always a very sensitive, media-friendly thing to talk about, in terms of jobs, brain drains, all those sorts of things. But as a net figure, we're not seeing astronomical depopulation. So yes, there is pressure. We're going to see that feed through into an upward increase in rents, but nothing. I don't think that's the predominant driver that's happening. I think interest rates is the big talking point. Yeah,
interest rates are the big talking point. Looking at housing transactions in that period, and on your graph here from 97 to 2000, there seems to be a slowdown in sale. I get the impression reading all this information in your research is that the economy, what would you call it, pretty stagnant?
In terms of growth, I mean, that's sort of, I wouldn't say it's stagnant.
I mean, we've got house prices, weekly rents, house prices. So 165,000 in 1997, 170,000.
Yeah, in terms of stock, it's certainly a stagnant market. I mean, even falling market, it's sort of, the figures in this sort of, the years, the 97 to 2000, we're seeing 88,000 to 65,000 transactions. And we're probably even seeing around 30 to 40,000 transactions per year when you look at the yearly difference now. And that's a significant fall in transactions, isn't it? So there's not a lot of throughput in terms of what's been sold, and that's what's slightly different, isn't it? Because everyone's been used to over this last 20 years low interest rate period that properties are just turning over so quickly, but things aren't turning over as quickly. So there's a little bit of trading. Not trading. There's a lot more thought into what people do with their properties, whether they hold on to it, whether they sell it, whether they do some clever financing, waiting for economic storms to blow over, things like that. And that's all driven by less stock going through the economy, but with that sort of peculiar investment component of what property manager would be interested in.
We're seeing a lot of stuff being built in places like Auckland, and as such, and so we're seeing flying over it yesterday, and you see all this stock being built and lots of developments going on. I mean, that's going to slow down rents once this stock comes online. We're not seeing as much, or I don't see as much in the provinces. Maybe you'd be able to give a better insights into that. Where is most of the development happening, and how does the provinces compare to our major centres?
Yeah, when you look at a lot of that, you can look through the Stats New Zealand sort of data, and it's all about building consents. And when you look at the graphs, it's all Auckland centric, and it's sort of major cities that are pushing out those consents.
Is that why rents in the provinces are potentially caught up with some of our major centres? I mean, we've said in the past, I mean, Gisborne, Palmerston North, the rents are on par with Christchurch. That wouldn't have been the case 10, 15 years ago.
Yeah, I don't think that's necessarily a typology question about new build. I think that's just a catch up of, Auckland really taking off. And, if you talk about overheating in terms of rental value, where you look at provinces, you're seeing a lower value and a bigger catch up. And people sort of realizing that yields can only go so far in Auckland. So people are looking to get returns elsewhere. So there's sort of, you're looking to where you're going to get better yields, for instance, and the big move away from big cities, getting bang for buck, better lifestyle, all those sorts of things. You look at Palmerston North and how it's grown in terms of population, and as you're saying,
Palmerston North has grown, hasn't it? I mean, I've been away for 8 years, and it's come back, and there's so much more development which has gone on it. So some places have grown. I mean, looking into the future now. I mean, you've shown that rents maybe not fallen, but certainly flatlined. Slight dip for a concerted period of time nationwide between a period of 3 years. Looking ahead, and difficult question, and hedge your bets each way maybe. What do you think is going to happen with rents across New Zealand as a whole, and will there be differences between the provinces and the cities?
Yeah, crystal ball time. I mean, obviously, there's always a big star and a caveat to everything we say. I think next year's political year, isn't it? You talk about markets. Markets are shaped by politics and sort of policy, I guess. So, the conversation we had at the start about regulation, that's going to have certainly going to have an impact on what happens with rents and what people can put forward as a rent for what people get in terms of quality. So, I think that's going to sort of potentially dampen what people can actually charge out, in terms of value, and landlords are going to be squeezed a bit more because they're going to have to pay for the costs of that regulation. That's going to be baked into, whether that feeds through to the tenant is always the big question, because often it does feed through to the tenant.
And historically, if you look at what's happened in the last 3-4 years with healthy, and I'm not saying it's a bad thing, but with healthy homes and things such as that, which has forced landlords to make investments into the property, you have seen that rents go up. Maybe also because quite a few rental properties have sold, and it's led to a bit of a shortage. Yeah. So what's your thoughts?
So that's sort of part of it. So it's the political question. I think interestingly, what came out of this research was when we saw that stagnation and that sort of pseudo dip was just at the point where there was a change of administration. So that's when it flipped to a Labour administration. So it would be interesting to see this time around whether we see a flip in. Because
that was going to be that was going to be my next question. I mean, you've got a political summary at the end of this report. Does whoever's in charge of the country, does it have an influence on rents, or is it just
certainly affects markets? Certain political parties are going to be more pro market, others are going to be dampen the market and regulate the market to try and sort of control certain social circumstances and certain qualities that's going to have an impact on what the landlord has to pay out for to deal with these sort of regulatory considerations, of course, and that point I made about how that's going to feed through to whether the tenant has to pay for that for that regulation, that security and that quality. So I think that's going to be something that plays a part in shaping that rental trajectory. And where does that go? I suppose I think if we follow the narrative of housing markets, I think market correction. I would argue that most of the country is aware that everything's had a dip, and the investors have run if they wanted to run. So I think we're starting to get to more of a normal market, in terms of the balance of a consumer investment, social sort of housing market. So I think it's going to now take a more sort of people getting more confident in selling, and which would mean sort of that feeds through.
So the reality of vendors is bitten now, and they're aware they're not going to get what they got 12 months ago.
I think so. I think reality is biting, like you say, and that's going to sort of give a bit of confidence if people see a normal working market now, rather than a media-driven shock sensitive market. People are suddenly sort of getting concerned if something's, they're told that suddenly houses is worth half than it was before, which isn't the case. People know that there's not a dramatic fall, I suppose is what I'm trying to say. So I think there's going to be a sort of a gentle rise again, and then probably a realization that it's not going to be like the glory days.
No,
I don't think so. There'll be a sort of a slight dip, and then you look at house prices. They tend to double every 10 years. Irrespective of all the media, the politics, everything.
So that's still is that still potentially the case? Even though we've had so many unique things going on, we've had a pandemic, we've got a war in Europe. We've had all sorts going on, supply chains. You still think that 10-year cycle, that's still relevant even now?
And underpinning all this is it's all about banks and lending. You look from a global point of view, it's all about that amount of lending that's been put into the system, and the ability for people to buy properties and invest in their being owner occupiers, which is the big great game, isn't it?
So let's say
that's going to feed through in a different sort of way now.
Okay, so let's say I've got a couple of investors there who have, last year they saw what was going on, or they decided to sell. Let's say September 2001, and they've got quite a bit of cash sat there. At some point, do you think they'll come back in if prices get down to a certain point? The investors get excited again?
I think I think a lot of people might have learned lessons about alternative asset classes, possibly. I know
alternative asset classes. So what you're talking about here is
stock shares, things like that.
Diversification.
You know, and there's a greater democracy in terms of what people can invest in now. You know, within your phone, you can start to invest. Not necessarily day traders, but you know, in terms of being sensitive to what your pension portfolio is doing, things like that. Whereas housing's traditionally been that sort of back of people's mind as a reserve pension sort of fund. So I think people are aware that there is alternative asset classes.
Yeah.
But New Zealand's a couple of things. It's a nation of property sort of obsessives. You've got a rental market, what, a third?
Yep, third of the market. Yep.
You know, so that's
that's not going to change, really, is it, Graham? It's not going to decrease. There's still going to be. There's always going to be that need for rental properties.
Yeah, and that's it. So you've got such big investment in property, as well as people living in property and buying and selling houses just to live in, and as well as the social condition as well. So I think to promote doom and gloom is probably a push too far. I know that sometimes I think you hedged your bets in this report, weren't you? You were saying sort of, it's going to be in that sweet spot, but I think it's not going to be doom and gloom, but it's not going to be the rosy, from an investor point of view and from a home ownership point of view of the rosy days of getting astronomical sort of returns. I think there's a bit of a reality checks come in. People took at interest rates. 2000 you were looking at what, 7.5% interest rates, and that was a fall from 9% from 97. So I mean, our generation before was a bit more.
I mean, I remember, Graham, just before around the GFC, and we were paying on our rental property about, look, it wasn't worth what it was now, but we were paying about 9-10% on interest.
Yep.
So, I mean, we've been there before. What's happened now is just the house prices are so much more. Servicing that mortgage is much harder.
Yeah.
On higher interest rates.
Yeah.
All right. So if people want to get hold of you, and ask you questions, what do they need to do? Are you advanced? Are you on Elon Musk's Twitter site, or do you just send you an email? What do they do?
No, I left Twitter well before Elon joined. Just Google the property knowledge. That's where I do a lot of my research. Soon to be at Lincoln University, heading the charge of their Bachelor in Land and Property Management course there. Through Property Brokers, we promote this report. Just Google me, Graham Squires, property knowledge with the Property Brokers. Okay, and the most important question of the day: who's going to win the World Cup? Oh, it looks like Japan today, doesn't it? It's coming home. Yeah. All right. Thanks for joining, and thanks for watching this. If you want to get a copy of the report, we've got the link. You'll be able to we'll be able to send that through, or you'll be able to see it on the screen if you're watching this on recording. And make sure you register for our newsletter that comes out every month. We've got lots of real useful tips and advice, market research, our quarterly report that we do with Professor Graham Squires, and we'll keep you up to date as to what's going on. Okay, and that's it from me. That's it from Graham. I'd all like to say, if we don't hear from you or see from you beforehand, make sure that you do have a very good, safe Christmas and enjoy it with your family. Okay, Nā te wā.